You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we take a deep dive into the world of advisors and options. We explore that intersection, explain how you, the busy advisor or asset manager, can utilize those products for your clients, or maybe you're one of the clients. You want to learn what your advisor should know, what they should be bringing to the table. Well, we got you all covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. Quite a few programs for you guys to choose from. Easiest place to find them all, of course, the mothership, theoptionsinsider.com. While you're there, click around, read some articles, some breaking news from the options market, all that fun stuff. And then if you want to take a deep dive into the radio, we got you there, of course, iTunes, TuneIn, Stitcher, wherever you find your favorite podcast programs. Also available, of course, via our mobile app, iOS, Android, and the beloved, ever-exciting Fire OS. And however you listen, before the fact, after the fact, before the fact might be kind of hard, after the fact, as well as maybe sometimes live or in between via the app, however you get the show, make sure you hit us up with those questions, those comments. We do love to hear from you guys. And joining me on the old program today, let's go in order of distance. These guys I know are beaming in the farthest, so they'll go first. Joining me is my usual cohorts there from Swan Global Investments, starting out with Mr. Chris Hausman. He is the portfolio and chief technical strategist over there at Swan. Chris, welcome back to the program, sir.
Hey, how you doing? Thanks for having me.
You sound super excited to be on, so let's try that again. Chris, welcome back to the program.
I am excited.
There we
Thanks
go.
for having me.
There we go. That's better. All right. And also joining me, I believe from upstairs or down the hall from Chris, somewhere in the labyrinthine Swan complex, also in Puerto Rico, is Aash Vyas, the director of portfolio strategy and overlays over there at Swan. Aash, welcome back to the program to you as well.
Thanks again. Always a pleasure.
And also joining us, he's been on the program before, but it's been a little while. You might know him from his regular appearances over there on our Option Block program, making a segue, a little sojourn over here to the advisor realm, Mr. Mike Tosaw from RCM Wealth Advisors. Mr. Mike, welcome back to the Advisors Option program, sir.
Always happy to be here on a lovely day to do a sojourn.
It is a lovely day to do a sojourn. I can't speak for Puerto Rico, but I know in our neck of the woods, it certainly is. It is quite lovely. And last but not least, joining us, I believe, from over there in NYC is Ilya Feygin. He is the senior strategist over there at Wallachbeth. Ilya, welcome back to the Advisors Option program to you as well.
Hi, Mark. Thank you for having me.
All right. With the gang assembled, then, let's get right into it. It's time to break out our tricks of the trade.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, everybody, welcome to the Tricks of the Trade. Like the man said, this is the portion of the show where we break down some interesting ways that we may utilize options that you can use in your own portfolios or indeed in your clients' portfolios, as well as some tools, some techniques, as the man said, some tricks of the trade we like to employ. And this is a very challenging time right now for a lot of people out there in the advisor space, asset manager space, who are looking to utilize options. Because frankly, a lot of you guys like to sell those options, usually at least as some component of your trading strategy. Maybe covered calls is pretty much what you do, in which case you're solely focused on the income side. Maybe you're like the boys over there at Swan, you like to do the overlays, so the income portion is one portion of your overall strategy. However you utilize it, chances are you have some income side, some short legs in some of your trading strategies. And a lot of you guys are hitting us up right now saying, these are challenging times. We are recording this here early in June here in 2017. A lot of people we know tune in well after the fact. But this year pretty much has been a surprising one for a lot of people in that we've seen pretty much the nonstop decline in terms of VIX, in terms of the implied volatility out there in the space, which is challenging. The lower that number gets, a lot of you tend to write options on broad S&P 500 type names. In general, the lower that VIX, the lower that volatility gets, the harder it can be for you guys to really maintain that consistent flow of income that maybe your clients have become accustomed to. So this is a constant complaint, a constant refrain we're hearing across the space, retail, professional, advisor, you name the segment. Everyone's kind of complaining about this these days. So we thought it would be a good time to maybe address it here on the show. So interesting stuff. There's a lot we can sink our teeth into, what's going on with implied vol versus realized, what's going on, how some strategies, some ways you may want to deal with this. Maybe we'll start with, I don't know, how about Uncle Mike? Because we'll let our guests go first a little bit. Mr. Mike Tosaw there. This is obviously a challenging environment for a lot of people here in terms of what they need to do and how they can get it done. You're obviously out there rolling a lot of positions, adjusting a lot of positions for your clients on a regular basis. How are you dealing with this low volatility environment? Are you choosing different underlyings? Are you changing your strategies? What is your approach?
I think it's a good question. Right now, at this day and age, the VIX is anemic, meaning you're not going to get a lot of premium if you're trying to sell covered calls on things. One thing that I'm doing personally is I'm really looking to try and, instead of selling covered calls as an example, I'm trying to sell more call spreads. I also am kind of modifying that within a diagonal spread. So for example, one position with which we're in right now, long the SPY August 232 call, so roughly 2 months out. And then in years past, I've sold just calls against it, kind of like a covered call replacement style strategy. But shorter term calls against it, I should say, whether it's weeklies or on a shorter term monthly, whatever the case may be. But what I'm doing now, at least with that strategy, is I'm selling call spreads. So for example, SPY is it was at roughly 244 on Friday when I did the most recent roll. I'm still long the August 232 call. It's roughly an 80 delta option. Started out when SPY was a little bit lower, was able to enjoy the upside a little bit. But instead of selling just calls against it, currently the position that I'm in, instead of just a short call, is the weekly. Weekly, it'll be 2 days from now. I sold it 1 week out, but we still have 2 more days till expiration on the weekly. The weekly 244, 245 call spread. and I got roughly between 40 and 45 cents for it. And the concept behind that is that, number one, it takes away some deltas. It takes some delta off the table, because if you have an 80 delta long call, you got a lot of exposure. And the first thing that I wanted to do was take away some deltas. So now I'm down roughly 20 less deltas. So I have roughly 60 deltas on the table per contract. The other thing that I did, it's actually kind of a half position, because normally I don't put that much delta on the table at once. So I have it out as a half position for most of the clients. Some it's a full position, but just kind of depends on the client's risk tolerance and a few other things. But what this does is, with the call spread, I'm still getting the roughly 40 cents a premium for the week, should SPY stay the same or go down. And the biggest hassle as a covered call trader that I've always found is that as soon as the stock goes high enough, you have to roll your call, or you have to watch it go up past the short strike price, and you don't get to be a part of it, whatever the case may be. And that's a problem. So what I'm trying to do with this in this environment, I still believe there's premium to be had, but I think selling a call spread in lieu of a covered call, and this could work on doing this if you're doing this against stocks as well, I believe that's the way to go in an environment like this if you are a premium seller. Now, of course, the other way with which you can go would be something along the lines of, say, just doing a diagonal or a calendar in one way, shape, or form. But if you're looking to be bullish, this is what I've been doing to deal with the low volatility.
It is interesting. It's a challenging environment. It's pretty much how you look at it. It sounds like you're adopting your strategies a little bit. I'm sure, Ilya, you're getting this question quite a bit as well. That's pretty much what you guys do over at Wallachbeth. People call you up and look to you guys to help guide their execution in the options marketplace. I'm sure your phone's ringing off the hook right now with people asking you this exact question. Hey, I'm used to selling premium in XYZ name, and right now the levels pretty much aren't what I'm used to. What can I do? How can I adjust that? So what are you counseling your clients? Are you telling them maybe to adopt different strategies? Are you changing underlyings? Are you saying, hey, sit on your hands, it's not worth it? What is the approach you guys are adopting over there at Wallachbeth?
Well, I think a lot of people are fixated on the fact that we have a low VIX. But my research found, I looked at any time the VIX declines below, let's say, 11, some low level since 1990, it hasn't been for no reason. It's because, the upcoming month tends to be very quiet. You've had a very low absolute return, and in fact, it tends to be the absolute magnitude of the 20-day move tends to be half the normal move. So, the market is not dumb. The reason why the straddle or the call or the VIX itself is priced low is because there's likely to be very little movement over the next 20 or 30 days. And what that typically is then followed by is a very sharp reversion, but later as time goes by. And so, during the period where things are not moving very much or just drifting up, what's really worked, and we discussed this in our last program, are things like ratio spreads, where, they've been useful on the way up, and they kind of protect you in case the market crashes while you're in it. So, they've worked fairly reasonably in single names as well as SPX. And they can also be used to play for a correction, so that if you think that SPX will go down a couple of percent, you could buy a put ratio spread, and which is fairly short dated, and capitalize on it reaching the terminal value. So those have been fairly decent strategies. Now, I think now we've come to a point where, the market is just extremely complacent from a strategy standpoint, and, we're likely to get some sort of correction this summer. And people have been, of that view, and they've been looking at ways to get defensive as we go into June and July. And, getting defensive doesn't necessarily always mean you have to go out and buy a lot of premium. You can do defensive rotations within your portfolio. One interesting trade you can do now is you can buy, let's say, a 3-month put on something that's more of a riskier part of the market or a broad index, and sell a 3-month put on something that's a little bit more defensive or safe, such as utilities, and actually take out premium, which is interesting. So if nothing happens, you'll net collect. So that's an interesting way to protect the downside. And for people who are looking for a correction but would like to buy the dip, they may be better off selling in the money calls against their stock, or selling the stock out altogether and selling puts, and then hoping they'll get a sign in them once the inevitable correction comes. So those have all been ways to play things. What we've advised people to do on the volatility and volatility risk premium side is to exit trades that are highly dependent on being short the VIX, because we think that will go up in a correction and hurt them. So we've advised people to temporarily get out of VIX premium selling strategies, VIX roll down strategies, and so forth, because they're going to take a decent drawdown, we think, over the next 3 to 6 months.
Yeah, that has been a very crowded side of the space, the VIX premium selling side of the space. A lot of people have migrated to that, of course. As you mentioned, it has worked out all right, but it's getting a little crowded, so the edge is not what he once was. And also, you're right, there is a potential for significant drawdowns in the near future if the VIX should pop, and there are many perhaps lingering things out there that could cause it to pop sometime in the near future. So definitely being net short units out there could be dangerous. But I like some of your suggestions. Of course, the ratio, maybe buying one and selling two, or if you want to go the other way, you could sell one, buy two, depending on how you want to structure it, how you want to approach the different names, depending on if you want to be net premium neutral, how you want to set it up. But there's a lot of ratios are pretty flexible. I think the in-the-money covered call is also an interesting approach. A lot of people tend not to go that way. I think they have it just programmed in their head for whatever reason that a covered call has to be out of the money. It has to be 3%, 5%, 10%, whatever the percentage is, and that's kind of how they treat covered calls, primarily because they want that that little bit of that capital appreciation as well. But there's nothing wrong with selling in the money covered call as long as you understand what that means. You're probably going to get your stock called away, and you can handle the tax repercussions of that. But if you're comfortable with that, you understand that, it makes sense. I've seen a lot of people try to migrate to that just because, as we've talked about on the show before, the volatility skew of most of the major equity and index names out there has a premium to the puts versus the calls. So if you migrate your liquidity into that call wing, that's a good way to get a little bit extra pop. Now, then again, as long as you can handle your stock getting called away. Do you see that as well, Ilya? A lot of people come to you and they think covered calls, they generally think of some sort of 3-5% out of the money call, and you have to maybe walk them back from that a little bit, maybe explain to them, maybe wrestle them to the ground a little bit with an explanation of why they should move to in the money covered calls, or are they more receptive to that?
Well, look at the back tested, 2% out of the money, BXY. And some people are just long mutual funds and are looking to sell SPX out of the money calls. And those are kind of standard things we see.
Yeah, it's been interesting. I'm sure you guys over there in Puerto Rico have been inundated with this question as well from a lot of people out there using the DRS. Obviously, the DRS has several short legs to it. It has the call side. It also has the out of the money put. So there's a lot of different ways you guys can structure that portion of the trade. So maybe, Chris, we'll start with you, and then Aash, if you have any things you'd like to add. But how are you guys navigating this? Are you maybe trying to be a little bit more flexible? Are you getting more, like Mike was saying, more into some of the weeklies rather than the monthlies? Are you getting into diagonals? Are you going more closer to at the money with the calls? How are you dealing with this drawdown in volatility?
Well, I'm going to take the other side here. The low volatility environment that we're in doesn't scare me as much as it scares a lot of other people. I think if you just started trading options the last few years or even the last 5 years, sure, this is quite a volatility. It's the first time you're seeing it. And I like to remind people that, hey, if you look back at 2005, 2006, early part of 2007, the VIX flopped around between 10 and 12 and didn't even poke over 20 during that period. Those were some great producing years, employing premium harvesting strategies. So we've been doing this for 20 years. Volatility ebbs and flows, it cycles. The risk premia ebbs and flows and it cycles. One of the things that we do is we have our strategies spread out over different small cap, foreign, developed, emerging, and so every. When we're looking at the risk premia and volatility levels for these products, it's kind of like Ilya said, hey, there's opportunity in different products. It's not just about the VIX. It's not just about the SPX. And you kind of stole my thunder a little bit earlier, Mark, with skew, because it's not just volatility, right? Where's your volatility? Well, the true volatility is really on your at-the-money strike, right? Your straddle, your at-the-money straddle. But once you start going off to the wings, you're starting to deal with skew. So I think being able to navigate this low volatility environment means you have to understand volatility. You have to know how it reverts back to its mean which is changing, always changing, right? Everyone always refers to the long-term mean of the VIX of 19.6. Well, that I think a lot of people think that we're never going to see that again, but we will. I mean, volatility cycles and ebbs and flows, and you have to be patient. So there are other things, pay more attention to skew. If you're trading wider call spreads, collars, wider put spreads, they're actually pretty skew-intensive instruments. So as far as volatility is concerned, it's not. We've got a long track record of managing premium type strategies, and so we've been through these environments before, and we're just going to keep doing what we've been doing over the last few years.
You guys have a nice, nice upside to the way you construct that portfolio too. Like I mentioned, there's a long leg and a couple of short legs, so you can kind of benefit in a couple different environments. If vol is cheap, it makes buying that put a little bit cheaper. So there are benefits to having multiple legs out there. So there you go, listeners. We've run through the gamut of ways that you can adjust your trading to take advantage of this low volatility environment. If you're primarily a covered call trader, you can migrate that a little bit closer to the at the money. Of course, there are risks inherent in that. Of course, if you lower it below, if you get in the money, just as long as you understand that the stock can get called away and you can deal with the tax consequences perhaps of that, and that's a great way to approach this too. You have to be a little bit more aggressive in these times. These are not the set it and forget it times. You could write a call maybe once a month or once a quarter and kind of just forget about it. You probably have to migrate to a little bit more active, a little bit more stay on top of it type of strategies, which I know some advisors don't like to hear. They're very busy, but that's the best way to really deal with this environment. You get into some of the strategies Mike was alluding to, perhaps some of the diagonals or the calendars if you're a little bit more savvy. Ilya was recommending perhaps some ratios. There's a lot of different ways you can go about it. Of course, you can always adjust your underlying as well if your clients are comfortable with that. There's a lot of volatility to be found out there as long as you look in the right place. Commodities have been fairly volatile of late. Some other names have been pretty volatile. So if you're willing to migrate away from broad S&P 500 names, there is volatility to be found out there as well. So it's up to you and your clients what you're comfortable with. But there are ways. I think the moral of the story is it's not the end of the game here. If you're a volatility seller or a premium seller and you're in this environment, you don't have to just wring your hands and give up. There are ways to approach as long as you're sensible and smart, and you're not just adding risk for the sake of adding risk. Remember, at the end of the day, maybe not selling is also an alternative as well. If you're not getting the reward that you're looking for, you're just putting on risk for the sake of it is not a good trade as well. So all of those are some good strategies. If you want to dig deeper into any of those, I encourage you dig into the archives of this program on our site or in iTunes or via our app. We break down a lot of those strategies in a lot more detail. We talk about ratios, we talk about spreads with wings, we talk about selling, a lot of episodes about trading volatility. So you can go dig deep into those if you want a little bit more of an in-depth discussion. We kind of wanted to do a quick little overview here at the top of the show to try to help you out. But now it's time for us to keep on rolling and perhaps explore a forgotten Greek. Yes, it's time for our Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. It's time for Options 101. This is usually the part of the show where we break down a basic options concept or strategy or technique and explain how you can use it in your own portfolio. And today, this is actually a fun one because we talk a lot about the Greeks on this show. And again, go check out our archive, some of our early episodes where we do deep dives into all the Greeks. When we mention the Greeks, we usually talk Delta, Gamma, Theta, Vega. That's pretty much it. Those are the top 4 Greeks we always talk about. But that's not all of them. And you may be scratching your head saying, what are you talking about? There are more Greeks. Yes, there are. And there is, in fact, the 5th major Greek. There are others, obviously, second-order Greeks and things. We won't get into those today. But in terms of the major Greeks, there's really 5. And the 5th one is what I often refer to as the forgotten Greek, bit of the red-headed stepchild of the Greek family. And it is Rho. And what Rho measures effectively is an option sensitivity to changes in interest rates. Now, you may hear that and instantly realize, hey, that's why it hasn't really been a big topic of conversation for the better part of the last decade here on our Options Insider Radio Network, because rates haven't really been moving that much. But now all of a sudden, and they've been effectively zero for the better part of at least the last 5 years or so. So Rho, not really a big factor. But now, as we're starting to see rates fluctuate a little bit, we're starting to see more interest in Rho. In fact, I use the questions we receive about Rho as a barometer, and you can pretty much count the number of times people have hit us up over the past 5 years or so on one hand in terms of questions about Rho. And in the last 6 months or so, that has definitely ticked up. So maybe that's an indicator, if nothing else, that rates are in flux and people are starting to be interested in Rho. So we thought, what better time to dive into this forgotten Greek than now? And who better to do it than the man who literally wrote the article on it, Mr. Chris Hausman over there at Swan. And you guys are always cranking out fun articles over there on the Swan website. Chris, why don't you give our audience a little bit of an overview of your article and why you felt compelled to write about Rho these days?
Well, it's pretty much what you said. I mean, we are now finally, the Federal Reserve is now in a raising interest rate environment. And for the most part, over the last 5 years, rates have been 0 to 1%. So Rho hasn't been an issue. It wasn't one of those topics, without delving into the model too much. Interest rates is one of the inputs into an option pricing model. So it is something that we need to take account of. However, with the environment, for the most part, it wasn't anything that people worried about. And especially if you're a shorter term option trader, there isn't going to be as much of an impact on option pricing with changes in interest rates. Rho really is a big Greek once you get into the longer term options. So if you're trading leaps, if you're trading anything that's 1 year or 2 years, Rho is definitely going to be one of those Greeks that you're going to monitor and watch, especially now that, rates are going to be rising. So, option forward value, right? The future, the forward rate, and then some of the inputs that go into the model, so interest rates, that's a cost. And then if you have, individual equities may also have dividends, and it's going to be a benefit. So it's very important to calculate what the forward rate is. And so because calls are a substitute for the stock. So if interest rates go up, your forward rate increases, and that makes calls more valuable. So calls have a positive Rho, okay? It's negative for puts. So if interest rates rise, it's negative Rho, they're going to decrease in value. So it's one of the things that we have to watch, especially if you're trading 1 year and 2 years out. So deeper in the money strikes will have more Rho. So deep in the money calls have more Rho. Deep in the money puts have more Rho. So it's a function of cash and the forward rate, and that's how you calculate future value, and then it kicks out Rho. But you're right, Rho is one of those things that's just not talked about, and it definitely needs to be one of the things that you look at if you're looking at risk management, especially if you're looking at the 1 year, 2 year.
Aash, this is obviously an area that doesn't get a lot of love. We've been at a lot of conferences lately talking about volatility, talking about VIX, talking about OIC, industry volume and trends and things. Nowhere has really Rho cropped up. But I think for you guys in particular, you guys are well equipped to talk about this from Swan, because you guys deal with this probably more than a lot of our audience, a lot of our listeners do, because as part of your strategy, you really like to put on those longer term puts around 2 years. So you're trading in the leaps, of course, the long-term equity anticipation securities, for those of you who don't know what the acronym stands for. So when you're playing on the leaps, Rho becomes a factor, even in these anemic interest rate times. It's much more of an issue than, let's say, if you're trading a weekly with 4 or 5 days to go. Interest rate's not really a factor. So walk us through maybe some of your thoughts on Rho, Aash, why you think it has become the forgotten Greek, and how important it is for you guys when you're out there trying to pick, which 2 year put you want to use to hedge all your risk there. How much of a factor Aash plays into, as Rho plays into that?
Yes, well, as you said, Mark, we definitely look at it. It depends on the kind of derivative. For equity and index derivatives, shorter end, it doesn't matter as much. For some stuff further out, it matters more. Or for products like, say, converts or fixed income derivatives, they're very aware of it. I think you had a big pop after, in the 10-year after Trump got elected. And I think that caught a lot of people's attention. So it is something we always monitor and account for, but it's been more of a factor, as you said, lately than it has over the past 5 or 6 years.
Mike, same question for you, obviously, with, this is not an area you probably have to deal with a whole lot. You're not trading a lot of leaps over there at RCM Wealth Advisors. But that said, you probably have clients coming up to you now and asking you about rates and how they impact options. So whether they know it or not, they're asking about Rho. So how is this factoring into your conversations with clients? And how do you typically deal with this when you're doing your day-to-day of establishing positions, rolling options, et cetera?
We haven't directly gotten too many questions about Rho. But we are very involved and very active in RevCons and all sorts of other financing vehicles. And the implicit financing rates on the forwards, because when you buy a call and you sell a put, you're long a synthetic forward. And the pricing of that forward versus being long the security for cash is dependent on obviously the interest rate, and in this case of stocks, the financing rate. So, for things that are hard to borrow, which a lot of our desk deals with, there is a premium for the put. So, when you buy put and sell call and buy stock, you're going to have to pay over parity. And that's what kind of our desk deals with. And there's been more M&A, more deals, more spin-offs, more activity, even things like what's going on with Yahoo right now. There's been more and more trading and interest in, basically RevCons, which are synthetic forwards. So we've had a lot of interest in that, a lot of inquiry, and these are ways that, large institutions manage their balance sheets. This is the way that market makers manage their short positions in everything, from ETFs to single stocks, and that's important. And one thing we've noticed in the financing markets, obviously, has been, at the beginning of the year, we had this huge widening of LIBOR, where LIBOR went up like 50 or 75 basis points over a fairly short period, and that obviously affected everyone's financing. Our strategic view heading into this year was that people were just way too panicked about rising rates, and we thought that everyone was kind of positioned for this fiscal policy bump that would not come, and we've been proven right. And now the market's repriced for a very, very dovish Fed rate hike path, where we're barely pricing even 3 hikes to the end of 2019. So, the market's kind of really come around to pricing our view, and, we've been strategically kind of long bonds, and it's kind of played out. And now, we feel like, the trade is kind of over there, and maybe time to take it down and, look for something else. But we think the RevCon is going to continue to be an effective way to manage financing risk for everyone. And regulation is pushing the banks more toward listed products also, with difficulties and penalties for having non-cleared, stock loan and so forth.
All right, let's go back out to St. Charles and try it one more time. Mr. Mike Tosaw, are you there, sir? And what are your thoughts on Roe?
I probably have a different perspective than a lot of the guys on this show in that with Roe, I occasionally delve into the world of indexed annuities. And so one thing that I've noticed with lower interest rates along with lower volatility is the fact that the spreads on indexed annuities are much less favorable now than they were many years ago, meaning that years ago you could have found an indexed annuity with zero market risk, but you're capped off at your upside at maybe 5 or 6% annually. And now maybe you'll find one at maybe 2 or 3%. So it's not something with which I use very often anymore for obvious reasons. But with that, what they're doing inside of the indexed annuities is they're just basically setting up an option hedge in one way, shape, or form most of the time. And with Roe as low as it is, it definitely has an impact in the fixed or indexed annuity world for that reason. So that's one area with which I'll delve into it. And like you had said, Mark, people are asking about Roe and they don't even know that they're asking about Roe. That's one area. Another area with which it could have an effect would be if you're doing a longer term collar. Like I talk about my silver collar on the option block a lot, and how, I talk about how I don't have anything to talk about with it, quite frankly. But with that being said, if you also have a longer term collar, that can also have an effect on, Roe can also have an effect on that, in that your collars would be more or less favorable depending on where interest rates are. And it's hasn't been much of a factor, but now that interest rates are starting to come back, it's something that definitely needs to be monitored and looked at, that to say the least.
I forgot you are playing in the Roe game now with your much ballyhooed 2-year collar out there in SLV. Did you consider Roe, sir, when you first put that on? Were you thinking about all the Roe implications, or were you just thinking of how you'd never have to adjust it or talk about it ever on any of our shows?
I was just thinking, I figured I'd have been on to like about 35 adjustments on that thing by now, but I think I've made one closing trade on it. So
there you go.
That's kind of why I figured it would be all over the map. I was looking at everything. I didn't look at the specific Roe numbers, but I did definitely factor that in my decision, and that with interest rates where they were, that's definitely kind of like a bond replacement-esque type of trade.
There you go, listeners. Tune into our option block program if you haven't heard Mike not talk about his 2-year SLV collar, which he literally has not touched, I think he said just once, since he planned to put on this epic sweeping 2-year position. But that's a conversation for another day. Chris, you kicked us off in the realm of Roe. You actually wrote the article about it. So if listeners, well, first off, give us your final thoughts here on Roe and what you think may be salient, relevant for our audience listening to this who is curious. And then B, if they want to learn more about Roe, where should they go to find your article?
Yeah, just to sum up Roe, I mean, anyone that utilizes option strategies must always be cognizant of all the potential risks. So, no option strategy is perfect. There's always a trade-off between potential factors that can alter an option's value. So even though options with longer-term maturities do have more exposure to changes in interest rate, this risk, and keep this in mind, is offset actually by lower decay costs and more stability with respect to volatility than shorter-term options. So it is one of the pluses that when you go out to the longer-term time frame, 1 year, 2 year out, yes, you're going to be dealing with some Roe, but you have some other advantages that compensate for that. So the rising interest rates actually. Another good thing, decreases the cost of put calendar spreads. And that's one of the things that we do. I mean, our protection is way out in the 1 year, 2 year space, and we re-hedge annually. So the good thing about a rising interest rate environment is that those put calendars actually decrease in cost because the longer term put that we roll into has more Roe. So it's actually before the hedge happens, it's actually decreases and is another advantage to a rising interest rate environment. So, I just want everyone to, make sure when you're trading, when you're putting your strategies together, yes, everyone's pretty cognizant of delta, theta, vega, gamma, but give Roe some love as well, especially if you're in that 1 year, 2 year space.
I think you should change the name of your article. You should change the title of your article to that, Chris. Give Roe some love. What do you think?
That would be better suited. Yes, absolutely.
There we go. Give Rose some love. Give us some love yourself. Head on over to the website, Swan Global Investments. You can click on it there. I believe it's under the Swan blog section, and you will find it in that area. Yes, Greek Lessons, Roe Explained. There it is right there. So click on the blog, and you too can read the soon-to-be titled Give Rose Some Love article over there on the website. Meanwhile, though, it's time for us to keep on rolling, see what's hot, what's happening in the world of advisors and options, that very hot and fluid intersection, because it's time to check out the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. This is the portion of the show where we break down, as the name implies, the hot stories, the breaking news, the big trends from the world of options as they pertain to you, the busy financial advisor, asset manager, etc., and so on and so forth. Let's kick things off. Actually, this was kind of a positive thing I noticed. We see there's a lot of people out there doing articles about, the dire things going on in the advisor landscape and how robots are encroaching on them. They will be the death of them all, etc., and so on and so forth. And also a lot of them, if they do write about options, it's usually few and far between we get any mention of options at all in any sort of advisor written material or online or anything like that. When they do, it's usually some sort of screed against options. In fact, we have a listener question about that a little bit later. Maybe we'll get to that. So that's why it was I think a little bit confidence boosting to see an article. I think this came out of Think Advisor. They were talking about why volatility is an investor's worst enemy and using it to search for alpha this year here in 2017. And, they hit on some things that you guys, Chris and Aash, you guys at Swan have hit on quite a bit about the benefits of effectively trying to mitigate volatility in your portfolio. And they mentioned an article, in their example here, a typical portfolio which has a 10% return over 20 years. If that portfolio had 8% volatility, it'd have a total compound return of 540% after 10 years. If it had 18% instead volatility, it would have just 400%. So dramatic swings in the net return of that portfolio just from a few extra points of volatility, a point we've covered on this show in the past. And you guys at Swan have a lot of articles about that over there on the site explaining that. In fact, I think we had a whole conversation, I believe it was with Mark or with Micah, about the impact of compounding, kind of how that's lost sometimes on people out there in the space. But what was more interesting about this article, I thought, was that then they get into some ways to minimize volatility in your portfolio. And they start off with the typical advisor fear, which is using your CAP-M model to, maximize your diversification across a variety of assets. And we can get to that maybe a little bit later about why we think or don't think that's the best choice. But the second thing I saw him mention, which kind of encouraged me, was that he also said maybe you actually might want to consider volatility as an asset class. And he mentioned some ETFs, mentions, of course, the VIX products or using, derivatives and options that have volatility as a kicker. And that to me was, I thought, a little bit of a nugget that, hey, the word is starting to get out there. We talked at OIC with the people from Cerulli and the OIC folks. We'll try to bring them on the show maybe next month to talk about some of their data. And they have data showing that advisors are starting to get the word, starting to use options more. And now it seems like even in some of the broader advisor-oriented media, we're starting to see that addendum, that last paragraph, that last little morsel that says, hey, by the way, you could use these other products that maybe could be better suited for you, which I think is a little bit encouraging. I don't know, Ilya, maybe we'll start with you. This is obviously just one little article, but I think it's kind of emblematic of a larger trend we're seeing in the space, whereas in the past, it was mostly options were ignored, or it was pretty much, these things are the worst things since sliced bread. Now we're starting to see a little bit broader approach and probably a little bit more embracing of the fact that for a lot of asset managers and advisors out there, options are actually a suitable tool. Are you hearing that as well over there at Wallachbeth, anecdotally, when dealing with your clients and customers, and also looking at the broad media aimed at this space, Ilya?
Absolutely. We're hearing this from a variety of different angles. I think the first angle from managing portfolios in general, we've seen some of our more sophisticated clients move toward totally different types of portfolio construction in general, where, for example, we have some advisors that trade volatility products with us that construct their portfolios in a very non-traditional way, where they have a bulk of their portfolios tied up in very, very safe investments that do not go down much when the market goes down. And then they allocate a very small portion of their portfolio on a notional basis to things that are extremely wild and volatile, but that produce, a really outsized returns in a trended bull market that we've had for the past few years. And to manage the risk of that volatile piece, they're often using options. Now, that could be as simple as just buying an in-the-money call on something that's wild and woolly so that when it finally does crash, you're only at risk for the premium. It could involve having upside strategies in inverse volatility ETFs. It could be that sophisticated because those are generating 2 to 3 to 400% returns, and even a small allocation to those with a limited risk kind of profile has really boosted the returns of these advisors. So that's one side. We're seeing alternative portfolio construction approaches, and when you take an approach where, let's say, most of your portfolio has little risk and a small amount has big risk, that big risk piece is going to, by definition, require optionality of some sort. The other side that we're seeing a lot of adoption is pensions and other investors have been conservative and have looked at options kind of with a negative view, are embracing systematic buy writing. And the insurance companies and other clients that we have are even going beyond that and investing in total return vehicles that pay off on a certain, volatility index or on a certain volatility premium index. And they're using that as an income vehicle in a yield-starved world and also to diversify away from the traditional sources of yield. And in that respect, there's growing acceptance of the fact that, volatility is another vehicle in an asset allocation kind of menu. And there are times when, it's superior to other types of allocations, and it could serve the same kind of roles, such as enhancing income, reducing downside risk, reducing correlation with existing products, etc. And the other thing that brings up, which, in addition to skew and row and everything else that people should be looking at right now is dispersion or implied correlation. That's been a big deal in the options market. We had very, very high implied correlation heading into the U.S. election because we knew that sectors would disperse and names would disperse. And now we're priced at a very, very low implied correlation. So, when that happens, index volatility is trading very cheap, both to the names and to the sectors. And that's also a critical thing to watch. And that affects portfolio risk by definition.
I'll toss to you then. I was setting you up, Aash. You can dive in on your own, but there we go. I'll toss to you. All right, Mr. Aash, any thoughts here on the ever-expanding impact of options and volatility even on the advisor space, either in the media or perhaps in the usage of these products by a lot of the busy advisors and asset managers out there?
Yeah, I mean, I would agree. I think this article is a step in the right direction. I mean, I think we're still in an equity-centric world, but as far as volatility being an asset class, I think you could make a very compelling argument. Volatility is the only asset class. And, the thing about scientific methods is, the real world tests a lot of theories, right? And, I think we saw the limitations of CAPM in the financial crisis. And I think we also know that if we're talking about, systematic risk with markets near all-time highs and volatility low, well, you really can't diversify away systematic risks. So you have to hedge it. And if you know what you're doing, the one thing I would disagree with the article is the title. Volatility isn't necessarily an investor's worst enemy. It's actually an incredible opportunity. If you can hedge it properly or sell income properly with discipline, to step in and be able to buy when other people have to sell and outperform over the entire investment cycle.
Mr. Chris, same question for you. Any thoughts about this article and what it means for the advisor space and the usage of options going forward?
Yeah, I just wanted to point out volatility as an asset class is something that we have been trading for nearly 20 years. And so it's definitely needs to be part of people's portfolio in one way, shape, or form. I think more and more people are hearing this catchphrase, right? Harvesting premia. People are a lot more in tune today where volatility levels are, where the VIX is. It's like in the media day in and day out. But again, hopefully in this program, we've opened the door to some people that there are other volatility products out there. People like Ilya can help advisors who are like, well, I keep hearing about this asset class, volatility. I want to get this. And so there's a lot out there. We've been trading for nearly 20 years here. So it's not, it's good to see that other people are getting on board and realizing that you can add value to portfolios.
All right, before we hop out of the buzz, I'd be remiss if I didn't at least mention the big news in the advisor space right now. We don't have time to get too deep into it. It's a very intricate topic. We'll probably have to bring on a guest down the road to dive more into the legal and regulatory minutia of it. But it is that old bugbear that we talked about a lot about a year ago on the show, and it seemed like it finally went away, which is, of course, I'm referring to the Department of Labor's fiduciary rule of their proposed rule. Of course, with the new administration, everything old is new again. Everything is up in the air yet again. So there's been a lot of talk about will they revisit that rule. Trump earlier this year, back in February, put out a memorandum saying he wanted, effectively, they had a deadline of June 9th to revisit this rule and decide if they're going to make any changes. Of course, for the lion's share of that time, there was no secretary of the Department of Labor, so it didn't seem like they could meet that deadline. They now have a secretary there. They said they are going to try to meet that deadline. But as we've said many times, this is a very, very controversial thing. People are lining up, as they did before, pro and con on this issue. Chamber of Commerce coming out with some new data saying that this rule is hurting small retirement savers. They're saying it's going to reduce access to small savers and small businesses. They're also saying it's going to start forcing some advisor firms to have to actually start picking and choosing their clients and not being able to service the smaller clients out there because they have to focus on the larger ones just because of the net unintended consequences of this rule. Others are saying, it's the best thing since sliced bread. It's going to protect a lot of people out there. But there are a lot of worries about unintended consequences. The good thing, I want to just leave you with this. Again, we're not going to have a deep dive on this. I'll probably be for a future show. I just wanted to touch on it because it is coming up in 2 days now as we record this, June 9th deadline. But it does look like, and I've talked to the people at OCC who did a lot of the lobbying against it the last time. As you recall, the big concern from an options perspective last time was that they had created essentially a list of approved asset classes that you could use in these fiduciary accounts and in effectively IRAs and things like that. And options were not on that list. So they were effectively going to be banned or prescribed from all future retirement accounts. They have addressed that. They amended the list to include them as of the last revision of it. And talking to all the people who are out there lobbying on the Hill day in, day out for this type of thing, they don't seem to have any concern that that will rear its ugly head again, even under the new provisions and some of the other acts and things. There's no inkling that they're going to be coming after options. So if you're worried about you're not going to be able to use options under the new version of this DOL rule, obviously it's not finalized. We don't know any of the details yet, but at least from all the things we're hearing behind the scenes, it doesn't sound like that's going to happen again. So that's at least a good thing. Of course, we'll have to keep an eye on this. This is just starting to play out, so we only have a little bit of an early inkling of this. But I wanted to reassure any advisors out there right now who are worried about this, quite frankly, saying, oh, this is going to ban what is the lion's share of the use case for options for a lot of advisors, which is IRAs. Looks like, at least for now, those are still on the table. All right, I'll make sure we don't hop off without at least giving some of you guys a chance to chime in here. We got a few minutes left, so let's open up a really quick office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Like the man said, this is the portion of the show where you guys take the reins with some questions, some comments for us and for my fellow panelists here. Kind of run up against this. We'll have to do a nice quick one here. Let's go for this first one right here on the list, because this is very appropriate to the subject matter we were discussing today, which was, of course, volatility, how it impacts your trading here. And we have a question here from Ian Wagner. He says, why should I trade volatility versus direction or just income? Is it just a simple preference, or is it a more favorable risk-reward profile? Why should he do this? This is an interesting question. Kind of goes back a little bit, not just to what we were talking about with volatility, but also with the Greeks. Vega, somewhat of a forgotten Greek sometimes for a lot of people out there who don't think of it. When they're just selling calls, they want to get their income, they don't think about the volatility levels that are involved in there. So it is an interesting one. Maybe, Mike, we shall start with you on this one. What do you have to say for Mr. Wagner here, who wants to know why should he care about volatility instead of delta or theta or some of the other Greeks people usually fixate on the retail side?
Well, I mean, I'm not one that does too much with volatility. I shouldn't say I don't do much with volatility directly, meaning I don't trade the VIX, but volatility is a very important factor in option trading. If you ever get out of an option before expiration, then you have to have an understanding that volatility can change the trajectory of delta, of gamma, of theta, whatever the case may be. Volatility is always the wild card with which you need to be aware of. For example, if you are an income-based option trader, meaning you're selling options for income, and you just sell a put, let's say, well, it's very possible the stock could go higher, which in theory you would think that, okay, the value of the put would go lower and I'll be in good shape. But if volatility goes up as well, Vega can trump delta. So I think you need to be aware of it, even if you don't particularly try to trade it, because you are trading it, even if that's not what you're trying to do. So that's kind of my view on it. And I think anyone who trades options needs to have an understanding of it. The only way that you can take volatility out of the equation is if you hold your option until expiration, meaning you know that you're going to buy a call option, you know you're going to give up all of the time decay in it for good. You're fine with that. You're just going to exercise your option at expiration no matter what. Or you're selling an option, you're just going to let the market do whatever it does. And you're just going to keep it until expiration, and then whatever happens, no matter what. That's the only way you can take volatility out of the equation. But keep in mind, you're going to have you're going to have to be buying yourself some Malox in between, in my opinion, if that's your style of trading.
Ilya, same question for you. What do you have to say here for our listener, Ian, who wants to know why should he really be too concerned about vol versus, the delta impact on the option or the theta? If he's looking to harvest a lot of theta, why should he be concerned about volatility, sir?
Well, I mean, he's probably right in the fact that in many basic applications for advisors, the Vega is very secondary because they deal with very short-dated options, and the delta dominates. As well as, the theta, because the thing just expires in 1 month. So it's true that for the short-dated option, it's not that critical because changes in implied volatility won't affect it very much. However, if you go beyond the basic applications, and then it is also true that, when you're selling lower vol, you often move less as well. So, that kind of mitigates the effects. But once you move past the basic applications and you look into VIX strategies, you look into longer dated options, the level of volatility is extremely important to the risk reward of the trade. And for the question, why trade volatility, it gives you an extra dimension that's not 100% correlated to the market to add value versus your benchmark. Because remember, you're an advisor, you're long the market. How are you going to add value versus your peers or versus your benchmark? Right? You're going to try to do stock selection. I mean, a lot of people aren't really doing that. You're going to try to change around the allocation of your portfolios. This gives you an added dimension to perform better on the way down, and also to perform better when the market is grinding up gradually with covered calls. So without using options or some sort of volatility, you don't have that added dimension. And then when you look at downside risk, there are very few things that consistently provide the big spike in crisis scenarios that implied volatility does, and that's the reason people use things like the VIX, because other assets have not been guaranteed over time to generate huge offsetting returns when the market crashes. Really, implied volatility has been the only asset that has consistently had outside spikes in a crash. And the people from Swan, can attest to that, and that's kind of the center of their hedging strategy.
Thank you for that, Mr. Ilya. Thanks to all of you who wrote in with questions. Obviously didn't have a chance to get to many of them on the show today, but we'll get to more on future episodes. We love to have these roundtables talking about a lot of different fun topics, and sometimes we don't get to answer all your questions. But don't worry, we read them all. We try to answer them offline if we don't answer them on the air. We'll certainly book them for a future episode of the program. But before we go back around the horn, check in with my cohorts here on the Old Advisors Option Program, see what they have cooking that may interest you. Let's start with our guests, our special guest co-hosts today, and see what's going on with them. Ilya, we'll start with you. If listeners are interested in what you're talking about here and how you guys at Wallachbeth can help them maybe improve their execution or the way they trade or their style out there in the option space, where should they go? What should they do?
Absolutely. I mean, our website's a good place to start, Wallachbeth.com. And my email, you can email me with questions about any volatility or option strategies. It's Feygin, Ifeygin, at Wallachbeth.com.
I like a man who gives out his own personal email, or his work email in this case, out there on the air. It's a brave man. Well done. Wallachbeth listeners, if you don't know how to spell it, W-A-L-L, so 2 L's, A-C-H-B-E-T-H, just Beth like you would.com, and check that out for yourselves. And our other guest co-host, Mr. Mike Tosaw from RCM Wealth Advisors. What is cooking in the land of RCM? Whether it's someone out there who's an advisor and maybe wants to learn more about this space, or maybe it's someone who's looking for an advisor who handles options. What do you guys got cooking for them, sir?
Well, if you're looking for an advisor that handles options, I definitely fit the bill with that. Or if you are an advisor and you're looking to go with a firm that is a little bit more options friendly than what you're at right now, feel free to contact me either way, 312-212-3531, or shoot me an email at mtosaw@rcmfs.com.
There you go, listeners. Hit him up to find out more about what's cooking over there in the land of RCM. And, of course, last but certainly not least, we got our buddies over there, the dynamic duo holding down the forts over there at Swan. So, Aash or Chris, what is cooking? I know you guys always have a lot of events over there aimed at the advisor audience, this audience, the 10th box event. So what is cooking from that perspective? And what do you guys have going on over there at the Swan website? I know we talked about Chris's article. What else can they find? And if they want to check it out, where should they go? What should they do?
Yeah, Mark. So as you know, we had a lot of success with our 10th box meetings last year, which is a series of with portfolio managers. And, Smaller setting, one-on-one, dive into the weeds of our strategy a little bit better. So we're in the process right now of scheduling out our next series of 10th box meetings that we're going to have across the country. So you can get more information about that at 10thbox.com. That's 10thbox.com. And of course, we're always pumping out a lot of great material on the markets, our strategies, what we've been monitoring, and our blogs, kind of like the row thing that we just did today. So you can check that out at swanglobalinvestments.com.
There you go. Check it out, listeners. If you want to see the 10th box itself, the website is 10th, so the number 10, thbox.com. That'll have the schedule for upcoming events once they get it all sorted out over there. And last but not least, Aash, you're always my go-to man for all sorts of dubious correlations. You've shared some great stuff with us. I think it was a divorce rate in Maine and the price of butter, or hot steam incidents and Miss USA accidents, all sorts of great dubious correlations. So why don't you leave us with one of those right now? What's the latest in your collection of dubious, or maybe in this case, maybe this is a prime indicator. If I'm looking for a gold indicator, maybe you found the next one. Aash, what do you got for us?
Yeah, Mark. I mean, we're dealing with some pretty serious topics here. Sometimes it's nice to find something light. We're looking at a correlation between how much beer gold can buy historically. So for those of you who look at the world in a relative value framework, this might be an entertaining way to do some research, especially as we go into the summer.
Yeah, so effectively, it's, I believe, and we'll put the chart in the show notes. We'll also share it out there for you listeners so you too can follow along. But effectively, it's how much beer can you buy with an ounce of gold? I think it's specifically at the Munich Oktoberfest. Is that correct, Aash? So this is specifically how much beer you can buy at the Oktoberfest with an ounce of gold. Is that correct?
Exactly. How much real good German beer you can buy with gold historically.
There you go. Good. That's the caveat. Good German beer, not some garbage stuff. So we'll include that in the show notes and out there on Twitter and stuff as well, so you too can enjoy and revel in Aash's many dubious correlations. This one may have some legs to it, though, more so than the Steam versus Miss USA contestants type thing. This one, if you're looking for a gold indicator, who knows? Maybe this is the one you want to hit. And on behalf of Mike from RCM, as well as Ilya from Wallachbeth, as well as for Chris and Aash, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. We'll get to more of them the next show, I promise. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.